Navigating the world of personal loans can be complex, but with the right strategy, you can secure an ideal loan that aligns perfectly with your financial goals. This comprehensive guide will walk you through every step of the process, from initial consideration to successful repayment, complete with real-life examples and expert tips. First, assess your financial situation. Before diving into loan applications, take a thorough look at your financial health. Budget analysis. Create a detailed budget to understand your income, expenses, and potential for loan repayment. Debt-to-income ratio, or DTI. Calculate your DTI by dividing your monthly debt payments by your gross monthly income. Lenders typically prefer a DTI of 36% or lower. Emergency fund. Ensure you have 3 to 6 months of expenses saved before taking on new debt. Real-life example. Emma, a 28-year-old graphic designer, realized her DTI was 40% due to high credit card balances. She spent 3 months aggressively paying down her cards, reducing her DTI to 32% before applying for a loan, resulting in better offers. Expert tip. Use budgeting apps like Empower or YNAB to get a clear picture of your finances and identify areas where you can cut back to improve your loan eligibility. Second, understand and optimize your credit score. Your credit score is crucial in determining loan terms. Here's how to make it work for you. Check your credit reports. Review reports from all 3 major bureaus, Experian, TransUnion, and Equifax, for errors. Factors affecting your score. Focus on payment history, which accounts for 35%, credit utilization at 30%, length of credit history at 15%, credit mix at 10%, and new credit inquiries at 10%. Rapid rescore. If you've recently paid off debt, ask your lender about a rapid rescore to quickly update your credit report. Real-life example. Marcus, with a credit score of 680, was offered a 12% APR on a $15,000 loan. He spent 2 months paying down credit card balances, disputing an error on his credit report, and avoiding new credit applications. His score jumped to 720, qualifying him for an 8% APR, saving $1,800 over the life of the loan. Expert tip. Aim to keep your credit utilization below 30% on each card and overall. Consider asking for credit limit increases to lower your utilization without spending less. Third, determine your loan purpose and amount. Be clear about why you need the loan and how much you truly require. Specific purpose, whether it's debt consolidation, home improvement, or starting a business. Having a clear purpose helps you borrow responsibly. Loan amount calculation. Factor in all costs associated with your loan purpose, plus a small buffer for unexpected expenses. Return on investment. For loans, funding investments like education or business, calculate the potential ROI to ensure the loan makes financial sense. Real-life example. Sophia needed a loan for her food truck business. She initially estimated $25,000, but after detailed research, including licensing fees, equipment costs, and initial inventory, she determined $32,000 was more accurate. This precise calculation helped her avoid cash flow issues during her business launch. Expert tip. Create a detailed spreadsheet outlining all potential costs related to your loan purpose. Include best case, expected, and worst case scenarios to ensure you borrow enough without overextending yourself. Fourth, research and compare lenders. Cast a wide net when looking for lenders to find the best terms. Consider traditional banks, credit unions, online lenders, and peer-to-peer lending platforms. Look beyond interest rates. Compare APRs, loan terms, fees, prepayment penalties, and funding speed. For specific purposes like debt consolidation or business loans, look for lenders specializing in these areas. Ryan, a teacher, found that while his local bank offered a 10% APR, an online lender specializing in loans for educators offered 7.5% APR with no origination fee, saving him $1,200 over the life of his $20,000 loan. Use loan comparison websites like Credible or LendingTree to quickly compare multiple offers. However, also check with local credit unions, which often have competitive rates for members. Fifth, leverage pre-qualification. Pre-qualification allows you to see potential offers without impacting your credit score. Pre-qualify with at least 5 to 7 lenders to get a comprehensive view of available offers. Use pre-qualification offers to negotiate better terms with your preferred lender. Ensure the pre-qualification process uses a soft credit pull to avoid impacting your score. Aisha pre-qualified with 6 lenders for a $10,000 loan. While most offered rates around 11%, one online lender pre-approved her at 8.5%. She used this offer to negotiate with her preferred local credit union, which matched the rate and offered more flexible repayment terms. Create a spreadsheet to compare pre-qualification offers side by side, including APR, loan term, monthly payment, and total interest paid over the life of the loan. Sixth, strengthen your loan application. Make your formal application as robust as possible to increase your chances of approval and favorable terms. Documentation preparation. Gather pay stubs, tax returns, bank statements, and proof of assets well in advance. Explain negative items. Prepare clear, concise explanations for any negative items on your credit report. Cosigner consideration. If your credit is less than stellar, consider asking a trusted individual with strong credit to cosign. Real-life example. Derek's credit score was borderline due to a period of unemployment 2 years ago. He included a brief letter explaining the circumstance, his subsequent stable employment, and perfect payment history since then. This proactive approach led to approval at a better rate than he initially expected. Expert tip: if self-employed, prepare a profit and loss statement and consider having your loan application reviewed by an accountant to ensure it presents your finances in the best light. Seventh, scrutinize loan terms and negotiate. Before accepting a loan offer, thoroughly review all terms and don't be afraid to negotiate. Fine print review. Pay special attention to prepayment penalties, late payment fees, and any clauses about rate changes. APR versus interest rate. Understand the difference and focus on APR, which includes fees and gives a truer picture of the loan's cost. Negotiation points. Beyond the interest rate, negotiate on origination fees, repayment terms, and even loan amount. Real-life example. Lisa was offered a $30,000 loan at 9% APR with a 2% origination fee. She negotiated the fee down to 0.5% and got a 0.25% rate reduction for setting up autopay, saving over $1,500 over the life of the loan. Expert tip: if you have multiple good offers, ask lenders if they can match or beat competitors' terms. Many have some flexibility, especially for well-qualified borrowers. Eighth, set up smart repayment strategies. Once you've secured your loan, focus on repayment strategies to save money and build credit. Auto-pay benefits. Set up automatic payments to avoid late fees and potentially qualify for an interest rate reduction. Extra payments. Apply any windfalls or extra cash to the principal to save on interest and pay off the loan faster. Refinancing opportunities. Monitor interest rates and your credit score for refinancing opportunities that could save you money. Real-life example. Michael set up bi-weekly payments on his 5-year, $20,000 loan at 8% APR. This strategy, combined with applying his annual bonus to the principal, allowed him to pay off the loan 8 months early, saving over $600 in interest. Expert tip: Create a loan amortization schedule to visualize how extra payments can impact your loan term and total interest paid. This can be a powerful motivator to pay extra when possible. To wrap it up, securing and managing a personal loan successfully requires careful planning, diligent research, and proactive management. By following this comprehensive guide, you'll be well equipped to navigate the personal loan landscape, secure favorable terms, and manage your loan efficiently. Remember, the key to success lies in thorough preparation, smart negotiation, and disciplined repayment.